Welcome to Chapter 2, and in this chapter we're going to take a deeper dive into what is considered gross income and what is not. So basically the IRS takes a pretty liberal view of what's considered gross income, and it's basically anything they say gross income is unless they specifically say that it's not included. So your book's got some tables in it that I have not pasted into the slides, but that give at least a partial list of what is considered and not considered in the calculation for gross income. But things that people may not think would be considered gross income are. For example, non-cash items are included in fair market values. Let's say, for example, that I prepare somebody's taxes, and and probably things like this I hear happened in the older days where professionals were paid with chickens or things like that. So, my client comes to me with a chicken and says, I can't pay you, but here is a chicken instead. That is considered income to me at the fair market value of the chicken. I don't know what chickens are worth, but anyway, that would be how I would calculate the income from that. Similarly, bartering. If I offer to do somebody's taxes, for example, and they are going to paint my office in exchange, the value that I receive for the tax work, so the painting of my office, whatever the fair value of that would be considered taxable income to me. This up here. The most common thing that we think of when we think of gross income is salaries and wages. And salaries and wages are reported annually on Form W-2, which probably all of you have seen at least one of, if not many, in your lifetime of working. Basically, 80% of all individual tax returns include at least one W-2. And the W-2s have boxes on them. Hopefully, when you get yours, you study it carefully and make an attempt to understand all of the numbers in each of the boxes. I know you probably don't. But anyway, in case you ever wondered what all those boxes mean, we're going to run through that. So box 1 is what your taxable compensation is. And you might think to yourself, well, isn't that just what I earned? And the answer to that is no. There may be, depending on what benefits that you have with your employer, things which are deducted, what are called pre-tax. So if you make contributions to a retirement plan, for example, and that is deducted from your pay, your reportable wages on box 1 are going to basically have that retirement contribution subtracted from them. Similarly, if you have money taken out for health insurance from your employer, that will also be subtracted prior to the calculation of what goes in box 1. So box 1 is not your true gross, it is your federal taxable gross. Box 2 is the amount of federal income tax withheld. 3 through 6 are Social Security, Medicare taxes. If you are a tipped employee, box 8 shows your tips, and box 10 shows any transactions related to flexible spending. So if you have a cafeteria plan set aside for dependent care or certain health care, that will be reflected there. Box 12 is a number of things can appear in box 12. And so what that number in box 12 is will correspond to a specific code. So if you see a code C, that is taxable group life insurance. And many employers offer group life insurance as like an employee benefit, and it is non-taxable up to $50,000. So if there is more than 50,000 and that the employer provides you as part of it, and many employers will provide the equivalent of a year's salary as a benefit. And if your year's salary is more than 50,000, the amount over that is going to be considered taxable. Codes D, E, and G have to do with contributions that are made into retirement plans. Via stock options, W is contributions to health savings account, and DD is how much your employer pays for your health insurance, not what you pay. And you know that can be really quite a breathtaking number if you look at that and realize, wow, I only pay this amount for health insurance, but yikes, look what my employer's paying for my health coverage. And you can really appreciate the true cost of healthcare, health insurance in this country, and the benefits of having an employer-sponsored health plan. Box 13 is checked if you're eligible to participate in a retirement plan. Box 14, other compensation, and 15 through 20 relates to state and local tax. And we have very little local tax in this area. There are some jurisdictions that have local tax, and certainly New Hampshire has no state tax. So you may have nothing in those boxes on your W-2. Accident and health insurance. So taxpayers can exclude, as I had said, any payments that are related to your group health coverage, or if you have an accident like it has the goose, AFLAC. Thank you. So if you have a policy through AFLAC that your employer sponsors for accident coverage, that's something that can be paid pre-tax from your health insurance, or from your wages pre-tax. Certain kinds of job-related meals and lodging are not considered part of your taxable income. If you have a job where you're required to eat on the job, at one point during college, I was working in a group home and I was required to eat with the residents. I didn't get any separate lunch break. I couldn't leave the premises. And so the meal that my employer provided me, it was really for their convenience. And so the value of that meal to me was not taxable. We also had overnight staff there that were required to sleep there as part of the job. That lodging that was provided to them was similarly not taxable to them because it was a condition of the employment and a convenience for the employer. Now, interestingly, with regard to the meals, under the Tax Cuts and Jobs Act, while the employer is paying for all my food that I have to eat on premises, they can only take a 50% deduction for it off of their income. And so not sure what the rationale for that was, but it might be a disincentive for employers to be offering much in the way of on-site meals if they can only deduct half of it. Flexible spending accounts. So these are accounts that can be set up for dependent care. So if you're paying childcare or you have summer camps, and whatever it is for, and I say summer camps, it has to be day camp. For children under the age of 13 or unless they're disabled, you can set aside money pre-tax up to $5,000 each year to cover that for the dependent child, and I should also add, or an aging parent. Now, there is also a separate deduction for child care costs on a tax return, but making the election to pay these expenses pre-tax through a flexible savings account is actually a much better tax savings than just relying on the deduction for childcare, because for anybody who's ever looked at what is allowed as a deduction on the tax return, it is a drop in the bucket compared to the actual costs. So this is at least a much better deal from a tax perspective. Healthcare, families can set up to $2,700 a year for things that, and this is something that we look at annually in terms of how much we're going to set aside. We look at basically, okay, how much are prescriptions that we have to pay for out of pocket? What co-pays are we going to need to pay? Who needs contact lenses? Who's getting glasses this year? Who's, this year my son had his wisdom teeth out and not all of that was covered by insurance. And so when we decide how much we're going to be contributing to that health savings account, we sort of look every year at what we think our out-of-pocket healthcare expenses are, and we can set aside pre-tax up to $2,700 to pay for those expenses. But if we don't use it all, then we lose it. We're allowed to roll $500 of that into the next year. But if we have more than $500 left over, then we lose that money. And believe me, we in December start looking at how much money's in there and trying to figure out who needs glasses, who needs contact lenses. Does somebody have something else that needs to be done that we can spend some of that money down prior to the end of the year? So it's something to be aware of because it is a use it or lose it provision. Let me just move this down here. So again, certain fringe benefits. We talked about group term life insurance. Up to $50,000 in life insurance can be excluded if the employer provides an educational assistance. So you can go take a class, for example, and they will reimburse you. They can do that up to $5,250, and it's not included as income to you. There may be discounts. So if you work in a clothing store and they give you a discount, the employee discount, the discounted portion is not taxable to you. And you can go through all of these. I think the thing that I run into often with small business owners that are trying to take a deduction for themselves is the athletic membership, and they all want to deduct their gym memberships. And it's important to note that this is the value of a membership. It has to be an on-site facility. So if an employer puts a gym in and there's a bunch of equipment there and everybody's able to use that, that is not taxable to the employees. That does not mean that the employer can pay for all of their gym memberships and that they don't have to pay for that. If the employer offers retirement planning services, so they'll have a professional come in and sit down with people and kind of go over their plans for retirement and set up a savings schedule for that, that is non-taxable to the employee. Prizes and awards are taxable income. So if you win anything on a game show, if you're on The Price is Right, and actually I don't even know what they give you on The Price is Right, but lottery winnings certainly taxable. When we see those big Powerball jackpots, they talk about what the jackpot amount is and then how much you receive after taxes. Now you'll see some questions on this in the homework, so this is something that you should be at least familiar with. But if an employer is giving an award to an employee and it is recognition for length of service or safety, so somebody's had so many accident-free days, the most that can be excludable from income is $400. So unless the employee has what's called a qualified plan award, if it's just a kind of they decide they're going to just do some sort of a promotion and they're going to say, let's see if we can reduce our on-site accidents in this year. And the person who goes the longest without an accident, or anybody who, goes the entire year without an accident, we're going to give them $1,000. Only $400 of that can be excluded from income. So let's look at an example here. We've got Joseph, who's an employee of Vesuvius Statuaries LLC, and he gets a clock for 20 years of service. Clock has a value of $1,500. So the first thing we need to ask ourselves is there a plan, a qualified plan for these gifts? and they tell us automatically that there is not. So we know that the maximum amount that can be excludable from Yosef's gross income is $400. And let me put this up here. Now, so Yosef's going to get $400 of the $1,500 tax-free, and then he's going to end up having to pay tax on the remaining $1,100 of value of this clock that he probably didn't want to begin with unless it was a really nice clock. But poor Yosef may not have cared one bit about this clock. It's probably got his name engraved in it, so it's not even like he can go sell the thing and get the money to pay the tax he's going to owe as a result of getting this clock. So poor Yosef's going to get the raw end of this deal. And I'm going to stop this video here, and we'll go on to the next video for annuities.